Let me end with what we are doing in our top performance and some of the things I'm most proud of. Okay, we've made significant progress on capital management. You know the story. Keith will give you the exact numbers, but we've reduced share count by almost 300 million shares. We started to have confidence in our earnings, more liquidity, and dealt with so many of the capital issues that we started to increase our dividend. We're giving guidance again in 2023, 10%, 2024, 10+%. One of the things I'm most proud of is our leverage and what we did. It took enormous discipline at a time where there's a lot of moving pieces to just continue to reduce debt. And now we've gone from $22.2 billion in 17 to $8.7 billion and a 17% debt to total capital ratio. And we've increased our subsidiary dividends. The dark blue is ordinary dividends and the green is extraordinary. It went from $350 million to $2.5 billion, and then we actually were able to get 4.1 with the extraordinary in 2024. Now, I don't have time to go through the history of AIG or what happened and why we didn't break up the life and retirement business in the past. Talked about DTA, talked about capital, but this is a big issue as well, is that how's AIG having ordinary dividends of $350 million going to service $4 billion of obligations? The answer is you can't. And there's no place to go in terms of getting more liquidity. That's for another day. But you can see the discipline of going from with $1.5 billion of core bridge, which was life retirement at the time, ordinary dividends. We're still $2 billion short. $2.15 billion would be specific in 17. Discipline, retiring debt, getting more liquidity, getting a capital structure that's fit for purpose for the future. And now we have a surplus in 2024 where we generate $2.75 billion. That does not include the extraordinary dividends, and the blue is our dividends from Corebridge. So we are self-sufficient, generating liquidity, generating profitability, and we're all over the uses and the obligations. If you look to 2025 through 2027, we should be generating around $3 billion of ordinary dividends. It may not be in 25, but it's between 25 and 27, and our uses will be $2 billion or thereabouts, generating $1 billion of excess liquidity just based on how we run the business. Compared to 2017, not a chance. How are we going to drive earnings and earnings growth for AIG in the future? Global personal, we've talked about it. There's lots of opportunities. We're going to improve our combined ratio of over 500 basis points from today over the next 3 years. And you can see, yes, we put every category down because we believe every category can improve. Got to have more growth, improvement in accident year loss ratio, reduce CAT, acquisition and expense ratio will improve. We'll get here. I mean, a 94 is an aspiration, but it's a very realistic objective. And then we talked about expenses, went from 38 to 33.2 this year. Take out travel, it's 32.4. We'll get below 30. I mean, we're going to have a lot of different ways in which we can do that. And I ask you to give me a little bit of a benefit. In 20 years that many of you know me, I don't miss expense targets. I just don't, haven't, won't. So this 30% will happen. And we're all over it. But with AIG Next, with AIG 200, let us go at the pace where we know that we're investing along the way and we're driving outcomes that are sustainable. And so that's the ask, but we will absolutely get there as fast as possible. M&A, we have financial flexibility. We have strategic intent. We're going to be very disciplined. Some of the key characteristics and assessment criteria we use is, are there product capabilities that could complement where we are today? Is additional scale in a business that already has scale helpful to us? Or maybe access to new geographies helps our global footprint. We'll be relentless on focusing on culture and that it's an actual fit within AIG and that it's an underwriting company. That's what we want. And there may be some adjacencies that don't exist today that we may want to explore over time. The financial targets, though, it will be accretive to EPS, it'll be accretive to ROE, and we'll be very thoughtful in terms of its impact to tangible book value. You'll see this slide, I don't know, maybe 4 times. Keith has it, Q&A. But here it is. I mean, this is how we're going to build the 9.1 and 24 to the 10 to 13 and 25 to 27. I don't need to read all the levers, but underwriting income is going to grow, expense optimization. We have opportunities in net investment income. Interest expense, we've done a lot with debt. I wouldn't spend a lot there, but we may get some more. And then the other two variables are going to be capital management and how we think about tax. So there's a lot of levers to pull. As Keith will tell you, is like, don't try to measure the boxes because they are put up there equally, so there is no discussion around it. They're all going to contribute, and we'll get there. One more note on EPS is that I think this is dramatic. I think it's exceptional. I want to point it out. If you look back to 19 through 23, Corebridge and Validus Re made up more than 50% over that period of our EPS. And so when we made the accounting election in 2024 that it were just having EPS from AIG, it was bold, it was right, but here we are. And so when we look at what we did in 2024, I think it was exceptional. And we gave up a lot of EPS in order to replace it with core earnings growth that's sustainable. And if you look back, we need to reposition this business to be leaner, more profitable, more consistent over time. So, that's the 20% CAGR. But look at what we've done. I mean, in 44% through 2022 to 2024. And then, of course, it's the 20% going forward. But you'll do the math, but you get to 2026, is that we've replaced all of Corebridge's and Validus' earnings in basically 3 calendar years. I don't know. I mean, we'll have to talk at the break. Are there other companies been able to do that and have confidence in it? We are, and really proud of what we've been able to do here. Yes, some of it's capital management, some of it is like really driving core operating performance consistently. So where we start is where we end. This is the guidance. EPS at 20% plus over the 3-year period. Our core operating ROE 10 to 13%, but we're going to do the 10% in 25. The GI expense ratio will be below 30%. And the expected dividends per share in 25 and 26 will grow more than 10%.